Hi everyone, welcome to today's video. So on this video, I'm going to help you understand how to predict market crashes. What are the indicators that you need to take a look at? Now, before you call me like, this is like, fake thing, this, that stuff. No guys, please listen to me carefully. Because if there is a pattern which we can study, some indicators that we can study, and if we are somehow able to systematically time it, there is a lot of money to be made. A story here is that, for example, in the recent 2020 crash, the markets were trading at 12,500, right? Nifty levels at peak. Then they dropped to 7,500, 8,000. And within a few months, they went to 18,000. So if you were able to predict the dip and you bought the dip, the chances are that you would have doubled or 2.5x your money. This is very fast growth, and this is where kind of generational wealth is made. So it kind of benefits us if we try to solve this complex problem, right? So I will give you my indicators, patterns, how you can roughly time it. Now, will it be perfect? Absolutely not, but it's common sense driven, right? So I will help you understand some systems, processes, and accordingly you refine it, right? So, okay, let's begin. 5-6 key indicators that I will speak. Please watch the video till the very end. The first key indicator is that you try to figure out the interest in the market. Now, how to do it? So there is a website called as Google Trends. You go there and you type out India. So look at data of Indian stock market, and one of the proxies for interest in Indian stock market are SIPs or systematic investment plans. Now go here and let's try to analyze this, right? So let's look at from 2004 to present, and what is it that you would notice? Okay, so there was like 2008 crisis, 2007-8. So SIP flatlined. Markets did not give return for these 2-3 years, and then there was like massive dip. Okay, so this was one, but back then the markets were not that mature in India. Or at least SIP was not that mature in India. Then what happened, right? Then this was like roughly, I would say 2014, right? Modi ji came to power. Massive interest in SIPs, right? So this is where SIPs peaked. And then there was a correction because there was US-China trade war that happened in 2016. So then the SIP interest died down here, okay? Then from 2020 onwards, there was massive spike in SIPs, right? So here is the peak which was made, and then there has been a massive drop. So what is a good time to actually do your SIPs? Well, here, not at the peaks. You should never do SIPs or run your SIPs in like prominence here at these points. You should primarily do it when others are not doing SIPs. Now, this is not a foolproof way. You have to play around with 3-4 data points here, but I'm just telling you how to somewhat assess it. Because SIP is not like perfectly correlated to stock market growth per se. In India, now it has become very popular. So now if you run this analysis from, let's say, in the last 4-5 years, then you will get very clean data, right? So for example, let's try to do this. This is 2022 or peak, right? So you can see that SIPs peaked here somewhere. And after this, there was a massive fall, right? In the stock market also and in SIPs also. And then here, there was another peak, right? So, यहाँ पे peak पे चल रही है SIP in 2024. Since then, market has given no returns, right? So, it has given negative returns in the last 1 year. Now, we are at a bottom, right? So, now it kind of makes sense to play with this. So, this data now is very prominent. Maybe like 10-15 years ago, it was not that prominent. SIP has become a great proxy, right? So, this is the first way I would kind of try to assess that, okay, are we heading towards a crash? Right now, the answer looks like a no. Why? Because SIP are not at an all-time high. One of the key criteria that we will use, right, is that we will check or attribute it to SIP. So at least Indian market is not at a crazy level. That's what I would say. This is one. Now, what implication can you draw from it? Okay, invest money, right? For example, if you want to put money in Nifty 50 and all that, you can definitely consider doing that, right? So this is one, pick some quality stocks. I do give commentary on my community. So in case you guys feel that I can be of help, definitely do check the links in the description comment box. I will release some commentary, okay? So now second key indicator of a crash is that there has to be something called as all-time high or ATH, okay? Now what is the meaning of this? Let me just quickly explain it to you. So for example, this was the .com crisis, this green dot, right? One. Market was at an all-time high here. Yes. Okay. What is the next big crash that you see? So we see the 2007-8 crash. So was the market all-time high here? Yes. Okay. What about this? This is COVID crash. Point number 3. Was the market all-time high here? Yes. Okay. Well, we are not at an all-time high, but as per this indicator, right, all-time high indicator, it is debatable that we are cheap. Okay. So what is the most likely conclusion? Because the first point told us if we just track the SIP data, interest in the market, it's dying down, right? But from a market data point of view, if you just look at it from an all-time high levels, have we hit all-time high levels? So not really. So if we combine 1 and 2 indicators, we are getting a little bit confusing picture. So we have to study more, right? We have to go into the macros, which brings us to the third indicator, which is corporate earning indicator. You have to align the second point about the market all-time high with the growth in corporate earnings. So here is some interesting data which I have pulled out, right? And you can take a look. So basically this talks about earnings slowdown before the bubble crash. For example, if you look at .com crash of 2002, there was a slowdown in corporate earnings, especially among tech firms before and during the crash. Now this is very important, before the crash, okay? So the earnings slow down first and then a crash happens. This is a very important point, and this is the reason why we need to keep an eye out on earnings report, especially in the US market, because the earnings report there is very clean. Okay. So, okay, what about like other crashes? For example, global financial crisis. There was a sharp decline in corporate profits leading into through the 2008 crisis. So again, it says in very simple words that there was an earnings slowdown before the 2008 crisis. What about COVID crash? Okay, no, COVID में ऐसा कुछ नहीं था कि earnings slowdown was there. Now, which brings us to the next point. So I hope the first 3 points are clear that, okay, when big crashes come, there is an earnings slowdown. Is an earnings slowdown happening right now? No. There is no corporate earnings slowdown that is happening as of now yet. It can very well happen in the next few quarters, I don't know. But as of now, no. So whenever we get a very clear indication that earnings slowdown is really happening, then I would definitely cut a lot more positions. Okay, which brings us to the fourth indicator, which is an unpredictable indicator. These are called as black swan events. These are once in a lifetime type of events, right? For example, COVID crash was completely unexpected. 2008 crash was completely unexpected. Trade war in 2022, was it a completely unexpected thing? You will say yes, I would say no. Why? Because in 2016 also, China and US fought over trade war. Okay, trade wars are fairly common, right? It's not nothing new. So this is point number 4. So the next key way in which you can track a market crash is that there would be some kind of bubbles in a very important sector. For example, in 2008, there was a bubble in the real estate sector. Now, real estate sector is really, really big. It formed a big part of US's economy, China's economy. Almost 33% of China's economy at one point depended on real estate. So long story short, real estate sector, there was a bubble brewing. Okay, so in 2025, where are we sitting? The most talked about topic here is artificial intelligence. Now, is there a bubble on artificial intelligence? So then we need to go and define the meaning of bubble. The meaning of bubble is that too much supply has been built, but demand is not there. Now, this was a key feature of the 2000 dot-com bubble also, that in 2001, 2002, there was something called as dark fiber optics that were built, which meant that telecom companies had taken like $3 trillion of loan, and they had laid kilometers after kilometers of fiber optic cable, and almost 85% of that capacity was never used. So in 2025, can we say that, you know what, okay, is AI in bubble? It doesn't look like it, because the demand is way too high compared to supply, right? There can be small corrections. Corrections means that, okay, 10-15% correction ho gaya and all that. But a crash means like, more than 20%. Is that going to happen? That looks unlikely because of AI bubble popping. But yes, there is always risk in other sectors. For example, financial sector might have a meltdown. Too much loans being given in India, that's a major concern, that if there is any major credit default that happens and if it percolates into different parts of local economies, then it can cause issues. Like Portugal, Greece, they had a localized debt crisis that did not spill over in the entire world, but Greece, Portugal were very, very badly hit, Spain, all these countries. Something similar might happen at a local economy level. Now, do I see this risk happening in India? I don't know. To be honest, I have not analyzed the topic that deeply, right? Maybe I'll make an updated video on that. But that risk is there in the Indian segment, because India is not exposed to like AI bubble, but India is more exposed to credit risk bubble, right? So we have to keep an eye out for that. Then comes the next point, and this is where people get very excited. They will keep on tracking a lot of unemployment data, inflation data, interest rate data, debt printing data, and they will throw questions like that, Akshat, you know what? US economy has printed like so much debt, and they are going to go under because the US dollar is getting devalued. So US economy dead. Okay, it doesn't work that way. Okay, so US economy has been printing debt, trillions and trillions dollars of debt for several years now. So there is nothing new which has happened here in 2025. US is over leveraged for decades now, right? So this is nothing new, right? These type of macro issues get solved, but they always give you an opportunity to buy the market cheap. Okay, so for example, up until very recently, interest rates were very high, and it was being expected that interest rates will come down to accelerate growth. Now, because of all this debate in 2022, there was a Russia-US crisis or Russia-US war in a way. Russia-Ukraine ka tha, but US was supporting Ukraine in a way, right? And they were going against Russia. So US kicked out like Russia from the SWIFT system, money transfer, dollar system, this, that stuff. And there was like a little bit of local issue there. Now, back then, what that caused was that it caused an inflation spike in the US because US and Europe had to import a lot of energy from elsewhere. So because of that, the local inflation, or inflation means price rise in the economy, happened really fast. Now, at that point in time, there were multiple bad things that were happening, right? One was that there was interest rates high also. Russia-Ukraine fought also, and the inflation was also high. So as a result, what happened in the US market? There was a correction. So when these 3-4 factors get together and they present a negative image, that is an indicator that something can go off, right? So is right now such a scenario, okay, debt is bad. Is inflation bad? Not really, at least on paper, war has been won. Is interest rates bad? No, not really. Is like local crisis brewing? Some new crisis has come? Not really. So long story short, there is no macro problem that we will say, generally speaking. So the most likely scenario, if I just consolidate these 5-6 points, is this, that okay, right now we are not in a crash. We are in a mature phase of a bull market, I would say, generally speaking, at least in the US. There are local risks in the Indian market. For example, there might be a credit risk or some localized issue might happen. That is there. The primary concern that, or the governments that are dealing with, is that the growth rate acceleration has been really slow. So as a result, there could be a corporate earnings slowdown. So the most important indicator that I will check or continue to monitor over the next few months would be the corporate earnings slowdown, because that would be a sign that, okay, this bull run has kind of matured. And that would be a time to cut at least 40-50% of your portfolio and wait for better times to reinvest. I hope that you enjoyed this video. If you did, do press the like button and join my community in case you want to learn more finance. I do teach everything practically. I'm a practical investor myself, so you'll really enjoy the experience. Give it a go, right? Thank you so much for watching, and I'll see you soon.